Time for another edition of Influence when we check in with people in the news, making the news, commentators we love. And today we welcome back from INSEAD's Dean Ilian Mihov. We're talking about inflation, and I'm sure you've heard the viral meme. What is inflation? It's when yesterday's price is not today's price. The fastest inflation in 4 decades, according to Howard Marks, has reached excessive levels in part because of stimulus monetary policy, he says, used to counter economic consequences. He says he's worried. In a Bloomberg interview, Howard Marks saying inflation is excessive. Higher inflation means higher interest rates. Higher interest rates means lower asset prices. He's not the only one worried. It's been said that inflation and not variants of coronavirus will be the biggest threat to the global economy in 2022. So, what exactly is and what should we be bracing for in Singapore when it comes to inflation? Let's check in with Ilian Mihov, Dean of INSEAD. Good morning, Ilian.
Hey, good morning, Michelle. Good to be here.
Thanks for helping us figure out inflation. I wonder if we could start with the drivers as you see it. What is driving global inflation?
Well, first of all, I think that I agree that inflation in the US and other developed economies like the Eurozone is a big issue. And I have been concerned about this for the last 16 months because I think that the stimulus, which was necessary to get the economies through the pandemic, and the fiscal stimulus, the monetary stimulus, they were very important. But at some point, when last year Jay Powell started talking about it's a transitory inflation, don't worry. Actually, I got really worried because the moment the Fed prints so much money and then the central authorities, the government takes the money and distributes to the public, that generates inflation. So when you look at the Fed, the Central Bank of the United States, in the last 2 years, they doubled their balance sheet, which means that they increased the amount of money that they have printed, roughly speaking. Some people might say, but that happened also during the financial crisis after 2008, 2009. But this time it is very different. And for the financial crisis, I went on TV, on radio, saying that it will not be inflationary in 2008, 9, 10, because at the time when the Fed was increasing their balance sheet, they were forcing or stimulating the banks to keep the money in their vaults or actually give it back to the central bank. Today, it is very different because through all the packages, the money actually has gone into the economy. And when you have increased money supply, at the end of the day, you get inflation. So transitory inflation, to me, is a bit of a problematic phrase when money supply increases because all inflation starts as transitory. All inflation starts because there is a shock somewhere, because something happened, supply chains, all price and so on. To remain transitory, the central bank has to react to this. The central bank has to say, we will not let this fuel further. But this time, the central banks actually stayed much longer than they should have stayed, and they let this money supply actually fuel inflation. So I think that today, 7% inflation in the US, 5% inflation in Europe, it's actually quite worrisome. And I think that it should be worrisome also for us here in Singapore, because we know that Singapore depends a lot on imported goods. So if prices in the US and Europe increase, they will increase also in Singapore.
So by late November in the US, we saw consumer price inflation running about 6.8%, and that was the highest since Ronald Reagan was president, three times the Fed's forecast at the start of 2021. Let's bring it here to Singapore. I mean, it's not, if it pans out the way you say it could, how bad could it get for Singapore businesses and individuals in 2022?
So again, inflation at the end of the day can have some spikes now and then for different reasons, but whether it becomes instilled in the economy and permanent depends on one and only one thing, and that is the central bank. What will MAS do will determine whether the central bank will determine where the economy will go through a period of very high inflation. Now, the central bank here, the MES, the Monetary Authority of Singapore, they use a very interesting rule. Actually, it's unique in many ways because they use the exchange rate in order to control inflation. So what we can expect here is that I think the central bank, MAS, will not allow inflation to increase. And the only way that they can do this is by appreciating the Singapore dollar. So my expectation is that if we continue seeing these high levels in the US, in Europe, in other trading partners of Singapore, the central bank here in Singapore has only one choice, and that is to appreciate the Singapore dollar further. That will reduce the cost of importing goods and therefore will reduce the inflationary pressures. So if they do it, then inflation may stay in the realm of 2%, maybe 3%, but it will not go to the levels of 5-7%. And that's a thing that's what I would expect, at least on the long-term basis.
So here in Singapore, we're hearing about the possibility of GST being increased this year. It's debated, much debated in the run-up to the budget being released in Singapore. Dean, what would raising GST mean for inflation in Singapore?
So it can create a spike. So when we raise taxes, when GST, VAT, sales taxes go up, it might generate a blip in inflation rate, but it is not a permanent increase in inflation. It's a permanent increase in the price level, but not a permanent increase in inflation. Even so, if we increase by 2%, maybe we'll see if all of this is transmitted into prices, which is a big if all of the GST is transmitted into prices, because companies also have the option of reducing prices in order to maintain the sales, then we will see one blip, one jump in price level, but the inflation is a measure, as you said in the beginning, of the prices yesterday versus prices today. So once this is absorbed in the economy, inflation goes back to normal. So it's just a jump. Even this, the central bank can address if they decide to tighten further monetary policy, so that actually prices go down, and therefore price of the good plus GST remains the same as before. So everything in the long run is in the control of the central bank. So both the inflation rate will go down after the GST hike, but also the price level can go down if the central bank decides to tighten monetary policy.
I wonder if you could just backtrack and explain for us again. Inflation could go down if GST is raised?
No. Inflation as a result of GST will go up. So let's suppose we increase GST as of January 1st, 2023. Then obviously price level may increase, again, depending on what companies do, by 2 percentage points if we go from 7 to 9% GST. However, inflation is measured on a month-on-month basis or year-on-year basis. So in February, it's already absorbed. So February versus January, the inflation rate will not be changing as a result of the GST because it's already in the economy. It's already increased. So you can imagine that it's like a jump and then it stays flat. Prices stay roughly flat. So when you look at the jump, that's inflation, but then when they're flat, there is no inflation. So it's a temporary effect on them.
So we heard in a debate in Parliament recently that Singapore does not expect persistent, accelerating inflation ahead, and Singapore is expecting cost pressures to ease gradually over the course of the year. This, according to our Minister of State. What do you stand on this? Where do you stand on this?
I mean, again, I think that this is possible. I mean, it's not guaranteed. It is possible if MAS decides to appreciate the Singapore dollar. If they follow their normal policy and they say, we want now to strengthen the Singapore dollar in order to reduce the inflationary pressures, we'll not see accelerating inflation in Singapore. And I think that's what they're going to do. If the minister is saying this, and probably that's where also MAS will go. But if they decide, let's keep the exchange rate fixed, if we say, we're happy with 1.35, let's keep it at 1.35 versus the US dollar, or they have a basket of currencies, but roughly speaking against the US dollar, then there will be inflation, and the inflation here will be the inflation in the US, more or less, plus minus, a couple of percentage points. But I think that, again, the important thing is to understand that it is in the hands of the MAS whether we'll see accelerating inflation or not.
Okay, if we could backtrack a little bit and talk about measures or the metrics that determine inflation. In Parliament, again, we heard Singapore's headline inflation rose to 3.8% in November last year. But core inflation, which has been termed a more useful gauge of rising prices, it excludes accommodation, private road transport costs, that came in at 1.6% for the same month. Can you explain to us the difference between headline inflation and core inflation? And is core inflation a more useful gauge of rising prices?
Yes. So most central banks around the world look at core inflation. And the reason is the following. There are differences in definitions of headline versus core inflation across countries. So it's not the same definition. So in some cases, in the headline inflation versus core inflation, you will include like energy prices or food prices. So in the US, the difference between the two is the food and energy prices. And the reason that you remove from the headline inflation these volatile items, and in Singapore it's different, as you mentioned, it's accommodation and private transportation is the difference. But the reason that you normally remove these items is because they fluctuate too much. They're very volatile. So when the central bank determines its policy, they will look at where's inflation today, what is the forecast of inflation, and they will react to this. But if you have a very volatile component, they might overreact. They might see, oh, inflation is increasing very much, but it's a component like accommodation that goes up and down too much. So they increase interest rates or they appreciate the currency, drive the economy into a recession, and then the next thing they see is that it was just a temporary increase. So most central banks will say, let's look at the core inflation, because it's a stable, if there's inflation, it's a stable increase in the inflation rate. It signals that we have too much money in the economy and we have to increase rates or appreciate the currency to withdraw some of this purchasing power or the transmission of inflation. And it's a much more stable way of managing the economy.
So if we look at core inflation, 1.6% for November last year, should Singaporeans be concerned?
I don't think that it should be a big issue. 1.6% is not definitely high inflation by any standard. What usually people are concerned about is the accelerating inflation. That's why the minister was referring that we will not see this. Because, last year, when we started seeing that inflation rates were going from 3%, and jumped in April in the United States, 3.3%, relative to the year before, that was a source of concern because it showed a jump that might be accelerating. And lo and behold, 8 months later, we have 7% inflation. So this is the scary thing, that once you start going into one direction, you don't stop. But 1.6 is not high inflation rate. And if the central bank MAS reacts here, then it will remain within this range, which is normal for a well-functioning economy. 1 to 2% inflation rate is absolutely acceptable.
Does it always come together, inflation and recession? I mean, what can we expect in terms of wage growth and jobs here in Singapore in the year ahead?
I think that it has been in the past, it's true. In the past, we have seen episodes, especially in the 70s, but during Reagan years, again, the Fed increased interest rates a lot in order to fight inflation. And then you have a recession. So what is important to know, at least from history, this time, some people might argue it's different, but I'm not sure it is different, is that in order to stop inflation, once it is fueled by money, by printing money, in order to stop inflation, you have to increase interest rates to be above the inflation rate. Which, think about this. Today we have 0.5% interest rates in the US. The inflation rate is at 7%. So in order to stop prices from increasing, normally you have to have high interest rate than the inflation rate, which means
So higher than 7%.
7.5. Yes, and that is scary. That's what they should have started a year ago to contain the spread of money. And I'm worried. I don't know exactly where interest rates will go and how it will happen, but I the markets in the world today are pricing for rates rate increases in the US. I think that will be much more than that. And actually, I think that the first month that will be able to make a better prediction is April, because up until now, inflation is usually measured year on year. So I hear sometimes arguments, yeah, there is inflation relative to last year, but last year was, pandemic, prices were low, the base was low. Now we're going back to normal. But in April 2021, when price level jumped by 3.3%, so there was inflation, we already at a high level. So if this year we maintain high levels of inflation, it's already relative to a high price level. And then I think that the Fed will panic. And I think that at this point that we'll see very rapid increases.
So we're expecting 3 to 4 increases this year.
I think more.
Fed, really?
Yes. I think more.
What are you anticipating?
I mean, I think it easily could be 5. And I think towards April, we will see where the Fed is heading. But right now, I cannot imagine how do you stop with $8 trillion balance sheet. How do you stop inflation from accelerating? In fact, and that is the issue. It's not just staying at 7%; it is actually going further up. And even today, a lot of companies are complaining that you see the increase in price, but also you see the wage growth. You see people are complaining that wages are increasing; they cannot hire at this wage. And once you have the wage price spiral, you need a very serious Fed intervention.
So according to a Bloomberg survey, the consensus is that the world economy will expand 4.4% this year after the 5.8% bounce back of last year. And that from 2023 onwards, that growth is going to return to its long-term norm of around 3.5%. Do you think that this is possible, and what impact could this have on inflation?
It is. I mean, it is possible. I mean, first of all, the world obviously has economies that right now in China, the inflation rate is not as large, and China might escape, this inflationary scare. But so there are economies that can pull up higher growth rates. But at the same time, I think that this is possible if indeed the kind of like it's called the Goldilocks scenario, which means that you just increase interest rates so much that you can stop inflation, but it doesn't hurt. These interest rates increase do not hurt growth. It is possible. I'm a little bit skeptical that we'll have these good growth rates. That who knows.
All right. Coming back to, so much depending on central banks' monetary policy, I'm wondering if you could share with us your thoughts on fiscal decisions and fiscal policy, and what could impact MNC's decisions to either invest in or locate here in Singapore. I think that matters to businesses listening in here.
Yeah, so now there is a big debate about the so-called BEPS, the Base Erosion and Profit Shifting Agreement, which sets, the minimum tax rate at 15%. So we know that in Singapore there are some international multinational companies that pay tax rates lower than that. I think that from my point of view, Singapore is a very attractive place for many other reasons. I don't think that if the tax rate for these companies goes up, they will move out or fewer companies will come. Um, Especially because now there is no tax haven to go to. If everybody has to have 15%, it's not like, I can move to another country. I can move to Vietnam or to Korea with a lower tax rate. Everywhere it has to be 15%. So I think that the attractiveness of MNCs for MNCs of Singapore is the stability, the macroeconomic stability, the rule of law, the transparency, the very skilled and educated workforce, the educational system, because very often, people, companies locate their headquarters here and they have to send, top talent, but, top talent, they have families, they have to send their kids somewhere to study. And I have seen people making these decisions based on whether the education system is good or not and relocating from one place to another. So all of these things, and it's a hub that is very well connected, very efficient. So the tax rates very often are they're important, but I would say, I think there was a survey a few years back. They're probably in the top 5 considerations, but they're not the top consideration. So I think that by maintaining this environment, by maintaining the stability and relatively stable exchange rate, relatively stable price level, all these things, that's what will attract companies here.
All right, before we let you go, Dean, we started by quoting Howard Marks. He's worried about inflation. You've mentioned you're worried about inflation. We're all worried about inflation. So the question is, what do we do with our money?
Well, invest in inflation, inflation protected securities. It is a difficult question. It's a difficult question because we know that when interest rates go up, and especially if they go up sharply, then you will see asset price volatility, especially stocks that are valued because of expected future earnings, let's say 10 years from now, profits in 2030 rather than now.
And that's why we're seeing tech stocks hurting right now, right?
Exactly. When interest rates are zero, I mean, there is a risk premium, but assume that there is no risk premium, then dividends that you receive today and dividends that you receive in 2030 have the same value if interest rates are zero, if you don't care about the time value of money. But and that's why, some tech companies that promise to you dividends in 2030 to 2050 are valued very highly, even though they have, they have losses for the past, 4, 5, 6 years. So you expect that in the future they'll start churning profits. But when interest rates go up, all of a sudden this distant future, because of the compounding, is valued much less, and it's probably in some cases might become worthless. So companies that depend on future profits far away in the future will see a lot of volatility compared to ones that are that actually give you dividends today. It's actually a very interesting question, because when you look at inflation for stock prices, right, inflation enters both the numerator and the denominator, in a sense that normally when we determine the stock price of a company, we look at the future dividends that we'll receive, but these dividends depend on the price level, right? So if I'm a company and I increase my price, my earnings will increase as well, right? So it's because of this, but also the discount rate, which is in the denominator, has the inflation rate. So roughly speaking, in the long run, the inflation rate should be canceling the two things, the positive effect on dividends and the negative effect on interest rates. But it is by how much, the key question is by how much will the central bank increase the rate above the inflation rate? And that will matter a lot. So
I keep
we'll
saying it's
see.
our last question for you. It's our last question for you. But when we have a gifted economist, it's hard to let him go. So, Ilian, one more question: is Singapore well placed to weather the inflationary storm we're expecting ahead?
I think at the MAS, I've worked with them, and I know that people are very concerned about this. They understand inflation is a very, very cruel tax on people because it's one of the most regressive taxes. Poor people lose much more from inflation than rich people because they most, especially if they don't have any savings that they can protect from inflation. Their earnings are continuously being eaten up by inflation. So I think that today we all understand that inflation is not good, not for stock prices. Forget about the stock prices, but they're not good for the people in general, for the middle class, for the low income people. And so my anticipation is that MAS will maintain the price stability by following their monetary policy rule, changing the exchange rate. So I'm optimistic. It might not be easy, depending on what the central banks in other countries do. Singapore is a small economy. Here we're very dependent on what the US does, or Europe, or China. So I think that it will be if the other banks do not go into some crazy mode of saying let's wait and see. If they start reacting, and Singapore reacts, then it should be a relatively easy transition. But if the other countries see inflation rates going into double-digit levels, it will be very difficult. Because again, it's like you can stop inflation. You can stop inflation by increasing, in case of Singapore, by appreciating the currency. But the appreciation of the currency will definitely lead to some losses for exporters, because then their goods will become more expensive. So it's not a free lunch.
All right, well, going to have to leave it there. Thank you all, as always, Ilian, for joining us. Ilian Mihov is the Dean of INSEAD. We've been understanding inflation and its possible impact here on Singapore.
Money FM 89.3.